Hey everyone, thanks for joining us again. We're so glad you're here for another deep dive.
Yep.
This time we're tackling a topic that's super relevant to a lot of our listeners,
Yeah.
especially the younger folks out there who are really starting to think seriously about building their financial futures and making their money work for them.
Right.
We're talking about mutual funds and ETFs.
Oh, yeah, those are big ones.
They're huge,
Yeah.
and sometimes they can feel a little intimidating, like, where do you even begin?
Yeah. So many options out there.
Right? It can be overwhelming.
Yeah.
So our mission today is to break it all down in a way that makes sense. No jargon, just straight talk about what these investment vehicles are, how they work, and why they matter for your financial journey.
Absolutely. We're going to unpack the pros and cons of each and give you some expert tips to help you figure out which one might be a better fit for you, or if maybe a combo of both makes sense for your own personal investment strategy.
Okay, so let's jump right in and start with mutual funds.
Mm-hmm.
I feel like most people have at least heard of mutual funds, but maybe they're not exactly sure what they are.
Yeah. It's kind of one of those things you hear thrown around.
Right, so in the simplest terms, think of it as a big pool of money from a bunch of different investors.
Okay.
And that pool of money is managed by pros,
Mm.
these financial experts. They take that money and invest it in a bunch of different things like stocks, bonds,
Mhm.
even real estate sometimes.
Interesting.
And the idea is that by spreading your money across all these different investments, you're reducing your risk.
Right. Diversification.
Exactly.
Yeah.
It's like that old saying, don't put all your eggs in one basket.
Makes sense.
So if one investment doesn't perform well, the others can help to balance things out so you're not taking a huge hit.
Yeah. That's the beauty of diversification.
And there are tons of different types of mutual funds out there.
Yeah.
You've got equity funds, which focus mainly on stocks. Then there are bond funds, which, as you might guess, invest mostly in bonds.
Yeah.
And then you have money market funds, which are generally considered lower risk, but also may have lower potential for growth.
Right. So there's something for everyone, depending on their risk tolerance and their goals.
Exactly. And we were talking about mutual funds. We can't skip over this guy, John Bogle.
Oh, yeah. He's a legend.
He really is. He founded Vanguard,
Yeah.
and his whole thing was about making investing accessible and affordable for everyone.
Yeah, he's the index fund king.
He is. He basically said, hey, it's really hard to consistently beat the market, so why not just try to match it and save a ton on fees in the process?
Yeah, that was revolutionary.
It totally was. He opened up investing to so many people who thought it was just for the wealthy or super sophisticated.
And that leads us perfectly into ETFs.
Exchange-traded funds, they're like the cool younger sibling of mutual funds.
Uh-huh.
I mean, they're both ways to pool your money with other investors and get that instant diversification.
Yeah.
But ETFs, they trade on stock exchanges, just like individual stocks.
So you can buy and sell them throughout the day.
Exactly. You've got that flexibility. Whereas with mutual funds, you usually have to wait till the end of the trading day to see what your shares are worth.
Gotcha.
And another big plus with ETFs is that they tend to have lower expense ratios.
Oh, that's always good.
Yeah, those fees can really eat into your returns over time.
Yeah.
So keeping them low is key.
Absolutely. And ETFs often have lower fees because many of them are passively managed.
Yes.
They're designed to track a specific market index like the S&P 500, so there's not a team of people actively picking stocks and trying to beat the market, which keeps costs down.
Right. It's a more hands-off approach.
And speaking of the S&P 500, did you know the very first ETF was actually based on the S&P 500?
No way.
Yeah, it launched back in 1993. It was called the SPDR S&P 500 ETF Trust, and it trades under the ticker symbol SPY.
SPY, like a secret agent.
I know, right?
That's cool.
That was a pivotal moment in the rise of ETFs, and since then, the ETF market has just exploded.
It's incredible how many different ETFs there are now.
Thousands, right? Covering every imaginable sector and investment theme.
It's mind-blowing.
It is.
Okay, so let's zoom out for a second and talk about the key differences between mutual funds and ETFs, because they both offer diversification, but they cater to slightly different needs and preferences.
Right, the structure is a big one. Mutual funds are those traditionally managed pools of money we talked about earlier, and ETFs trade like stocks on an exchange.
And that difference in structure also influences the management styles and ultimately the costs.
Exactly. Many mutual funds are actively managed, which means there's a team of professionals constantly researching and making decisions about what to buy and sell within the fund.
They're trying to beat the market.
Exactly. And that expertise comes at a cost, so those funds tend to have higher expense ratios.
On the other hand, ETFs are often passively managed, just tracking an index, so their costs are usually lower.
Now, another thing to consider is liquidity,
Which basically means,
how easily you can buy or sell your investment.
right,
So ETFs, because they trade on exchanges, offer what we call intraday liquidity, meaning you can buy or sell them anytime during market hours.
But with mutual funds, you typically have to wait till the end of the day to buy or sell.
Exactly.
So that's something to keep in mind depending on your investment strategy.
As
And of course, we got to talk about costs again, because even though ETFs often have lower expense ratios, you'll usually pay a brokerage commission every time you trade.
Right, just like when you're buying or selling individual stocks.
And with mutual funds, you might not pay a commission up front, but those ongoing management fees can add up over time.
Definitely had to factor that in.
And taxes, too. Don't forget about taxes.
Oh yeah, taxes are a whole other ball game.
So depending on how a mutual fund is managed, it can sometimes generate taxable events for you, even if you haven't actually sold any of your shares.
That's because when the fund buys and sells securities within its portfolio, it can realize capital gains, and those gains are distributed to the fund's shareholders who then have to pay taxes on them.
Right. And ETFs tend to be more tax efficient because of how they're structured. There are fewer of those taxable events.
So that can be a big advantage for some investors.
Okay, so we've covered a lot of ground here, but how do you actually decide which one is right for you?
Well, it all comes down to your individual circumstances and goals.
So let's get into some expert advice. Sounds good. Our first tip is to define your investment goals.
Yeah. Are you saving for a down payment on a house in the next few years? Or are you thinking about retirement way down the line?
If you have short-term goals, the relative stability of certain types of mutual funds might be appealing.
But for long-term goals, the flexibility and lower costs of ETFs could be a better fit.
It really depends on your time horizon.
Our second piece of advice is to evaluate costs carefully.
Oh, yeah, we can't stress this enough.
You absolutely need to compare those expense ratios and any other fees associated with both mutual funds and ETFs.
Every little bit counts.
And it's not just about finding the lowest fee, but also understanding the value you're getting for what you're paying.
Right. Are you paying for active management that's actually delivering superior returns, or would you be better off with a low-cost index fund?
That's the question.
It is.
Okay, tip number 3. Think about those tax implications. Yeah, if you're investing in a taxable account, meaning it's not a tax-advantaged retirement account like a 401k or an IRA, then the tax efficiency of ETFs can be a real game changer.
Because you'll keep more of your investment gains over the long run.
Exactly.
And finally, our fourth piece of expert advice is to assess your own personal risk tolerance.
Yeah, how comfortable are you with the ups and downs of the market?
If you're okay with more volatility and you're in it for the long haul, then ETFs might be a good choice.
Especially those that focus on specific sectors with high growth potential.
But if you're more risk averse and you prefer a smoother ride,
Then you might lean towards more diversified mutual funds.
it's all about finding what aligns with your comfort level.
Absolutely.
Okay, before we wrap things up, let's throw in some fun facts just to keep things interesting.
Yeah, let's do it.
Did you know that the very first mutual fund was launched way back in 1924?
Wow, that's almost 100 years ago.
It was introduced by a company called MFS Investment Management.
I had no idea.
And fast forward to today, the ETF market has just blown up. There were over 8,000 different ETFs available globally as of 2023.
That's insane.
It really is. And they cover everything from broad market indexes to niche sectors like cybersecurity and even cannabis.
The variety is incredible.
It is. So the main takeaway here is that there's no one-size-fits-all answer when it comes to choosing between mutual funds and ETFs.
It's a personal decision based on your financial goals, your risk tolerance, and your own investment preferences.
Both mutual funds and ETFs can be powerful tools in building a diversified portfolio.
They just have different structures, management styles, and cost profiles, so understanding those nuances is key to making the right choices for you.
To recap quickly, mutual funds offer professional management and that built-in diversification.
While ETFs provide flexibility and often come with lower costs.
So the more you know about these options, the better equipped you'll be to make informed decisions that support your long-term financial well-being.
Absolutely. And as you continue on your financial journey, we want you to think about this. How do the unique characteristics of mutual funds and ETFs fit into your own long-term financial plan?
What specific funds or ETFs might you be interested in exploring further, based on our conversation today and your own individual goals?
That's something to ponder as you continue to learn and grow as an investor.
Thanks for joining us on this deep dive into mutual funds and ETFs.
It's been fun.
We hope you found it valuable, and we'll see you next time for another insightful exploration of the world of personal finance.
See ya.